Happy Financial Fitness Friday. Here's a disclaimer. As mentioned, as I've always said, this is not advice or specific recommendations. But hopefully you find this helpful and educational. But I plan to, I record these and then post this and the slide decks for free. So can you give me a thumbs up that you agree to allow for recording? And obviously, I'm not making money on this, so you don't get to make money. I'm not paying you either. Okay, let's see. Okay, good. Most people, the first question, get to it. This is just since we're talking about tax planning and Roth versus traditional, just want to make sure everybody understood the way. So most people realize the U.S. does have a progressive tax system. So as you make more money, you get taxed at higher rates. And then value-added tax, they have that in other places in Europe, but not in the US. Let's see, the next question. Okay. Yep, good. If you're in the 22% tax bracket, only a certain portion that's in that 22% tax bracket gets taxed at 22%. The rest there's 10% and 12% ahead of that you get taxed at through those brackets. So your effective tax rate is actually lower than 22%. 3, do you know your federal tax bracket you're currently in? Okay, and we'll go over that, but it looks like under half actually know their tax rate, which that's important because of these considerations. When you're looking at Roth versus traditional, it's important to understand where you are in your tax bracket, what makes the most sense for you, looking at now, looking at years down the road. It's not about just saving money on taxes this year. That's stupid way to think about it, which is too often how we've always done it. You want to look at long term. How do I give the least to Uncle Sam in the lifetime? So you could save tens plus of money of tens of thousands of dollars if you do this better. Okay. When do you think you're today or in retirement? Okay, most people do think it's going to be higher today. It's questionable. We're in very low tax brackets historically, but people that have a pension, like military retirees, you likely are not going to be potentially in a lower tax bracket ever. And it depends all on RMDs as well, but that's why we're going into this. So a lot of people think about the same, but this goes into, do I do Roth now or traditional now? And how do I minimize taxes throughout life? 5, have you ever done any intentional tax planning like Roth conversions, et cetera? Okay, a quarter have, half have not. They'd like to, and then some leave it up to their advisor accountant. If it's up to the accountant typically, because they think you want to save tax money today, so they don't really do tax planning. They try to do as much to save you in taxes this year, unless you have a long-term relationship with them and likely with an advisor where you're like, nope, we're going to pay a little more this year so we can pay a lot less later. It's just but CPAs typically they think everybody just wants to pay less taxes this year, so they don't do tax planning. They just try to give you let you pay the least this year. Okay, how do you contribute to your 401k? Most are all traditional, and some are a combination. Nobody does all Roth. Interesting. We'll see how as we go on. That if you're higher salary, that makes sense. If you're not, maybe you want to increase that Roth bucket. And if you're military active, you should be Rothing it up. 7, do you have an IRA? Okay, most half have a Roth, 1 has a traditional, and 3 out of 8 have both. I think everybody ultimately leads both. And so you can keep the traditional if you're just using a Roth at a zero balance. And Rich, as you asked, we'll talk about how to do a mega backdoor Roth and why you need both of those accounts. Okay, do you max fund your IRA annually? Good. Most people, over 50% do. The other don't. Hierarchy of saving investing, in my opinion, start with the 401k match, get that, and but then max out your IRA, your Roth IRA preferably, and then go back and increase your contributions to your 401k, because Roth IRA has better investing opportunities, cheaper. It's just better all around in general after you get that free match money. Have you max funded 2025. Okay, that's why I'm glad we're doing this today. If you, half the people have not, by Wednesday, you've got to contribute for 2025. You've got $7,000 for 2025. If you turn 50 or older in 2025, not this year, then you have an additional $1,000 catch up for 2025. When you select your contributions, it'll default to 2026. So get that money in before Wednesday and select the 2025 as the contribution year so that you maximize your 2025. And then you've got till tax day next year for 2026 contributions. Okay. Okay, most don't have a high deductible health plan. If you're retired military, you can't. So, and then this, interesting, if people that have an HSA, if you have it, most people, 3/4 are spending it all, which is unfortunate. That money, it does not have it's not a use it or lose it. You can invest it, and it's the most tax advantage account ever. You can save all your medical receipts and pay yourself back 20, 30, 50 years later on all that growth, tax-free growth. So that's the right way to do it if you can. Pay out of pocket and then reimburse yourself years later. Okay, any questions on those? Nope. Okay, we'll move on. Yep, I'll go. Okay. Here's the agenda. Things will, these are basic things we'll be discussing in here. And if you have questions, ask them as we go. I'm not also good at monitoring chat during these, so just raise your hand or just speak out. Actually, I'm good with that. And then if you have to cut out early, if you don't mind, if you could take a survey, I'll have this QR code at the end as well. But if you don't mind, it's just a couple of questions that helps me, see if it's valuable to you and anything that that I could improve on to make these better. Okay. So anybody want to explain what's the difference between Roth and traditional, and why we're even talking about this?
Yeah, traditional is you deduct it from your income now and you pay taxes on it when you withdraw it. Where a Roth, you pay taxes on it now and you withdraw both your contributions and all earnings tax-free in the future.
That's correct. So long as you meet the 8-year requirements, like 59.5 or what have you. But that's correct. So traditional, it's pre-tax money. It lowers your AGI this year so that but all that money, and that money grows tax deferred, but all that money coming out is income down the road and subject to RMDs, required minimum distributions, when you reach that age. For everybody in here, that would be 75. I'd guess it's 73 if you're born before 1960. From 1960 on, it's at age 75. Roth is like I said, you pay taxes now, but then all that growth is tax-free later. Okay, and let's see. So in 401ks and RIAs, they all have this option typically. Most 401ks all have it now. In the military, it was 2013 when they finally started Roth contributions. But nearly every account has that, where you can contribute either Roth, traditional. Traditional means pre-tax, and or a combination. All have typically a combination of both, which is often advantageous. But the RMDs, if you've been just deferring taxes doing traditional, you could be subject to large RMDs later, and you have no control of your tax rate later on in life. So any questions here? I think it's everybody kind of already understands this. Okay, these are vehicles I've talked about, different things. And what I said here, okay, can these different vehicles, 401k/TSP, can they use traditional and or Roth? Most of them, the HSA is like a combination of both. It comes out pre-tax, it grows tax deferred, and then if you use it on medical, all that growth is tax-free. So it's like the benefits of a Roth and traditional at the same time, except for California, of course, taxes it because they suck. But still, it's a great option. But if you're retired military, you can't use it because you've got TRICARE. 401ks, though, you can do Roth or traditional. IRAs, Roth or traditional. Brokerage account, nope, that's just after tax money. that's then subject to capital gains. And then Social Security, obviously, no, that's just money comes out in FICA taxes. And hopefully people know this, but you don't put into your account. Our money is going to pay, the money we put in right now is going to pay in people that are already on Social Security. So it's not like you get your own Social Security bank account. It just depends on, the money coming in and that trust fund, which is, likely to get depleted in 30, 35 or 36. Okay, I put here's the income limits to contribute directly to a Roth IRA. And I put this is for 2025 because some people, obviously, half of the people have not completed their 25 contributions. If you're single above 165K of your, Maggie, the modified adjusted gross income, or 246K, you cannot contribute directly to a Roth, but you can do a backdoor Roth, which we'll go through those steps. If a traditional IRA, which everybody in here probably has a 401K they're contributing to, well, it's totally not. These income limits are even lower to be able to deduct that money. Look at how small this is compared to even the Roth, 79 to 89K for single, 126 to 146. You cannot deduct that money. So put it into a traditional and keeping it there doesn't even make sense, in my opinion. That's why the benefits of a backdoor Roth, where you contribute non-deductible to the traditional IRA and then convert it to Roth, makes way more sense. Here's the 2026 limits. It's the income obviously went up a little bit, the brackets, but the contribution limits went up $500, and now the catch-up is inflation adjusted, so it went from 1,000 to 1,100, and that'll keep going up as the years go on. The catch-up contributions for those the year they turn 50 and beyond will continue to increase with inflation. So people at 50 can do 8,600 this year. Okay. So we'll go through the steps of what a backdoor Roth IRA conversion is. If you're above the limit to contribute directly to a Roth, then and the IRS, and you do it anyway, the IRS, if you don't pull it out the next year by October, like 15th, you can start getting charged a penalty of 6% per year on that amount. So you just don't want to do that. When there's a simple way to get that money in Roth. So what you do, that's why everybody needs to have a traditional IRA. Real quick though, if you're below the income limits to contribute directly to a Roth, then just contribute to the Roth. That you want the contributions if you can. Conversions have a 5-year ladder anyway. So if you can contribute directly to the Roth, to do that. But if you're above the income limits, which is a good problem to have, this is how you do it. You contribute, and I like to do this January, do it all at once in the year if you can. Max out your contribution, typically 75 to 80% of the time, market is up throughout the year. So, and for simplicity, you just contribute the entire amount January 1st, if that's a Monday or whatever that first Monday is, first day of the year. Contribute the max amount. It takes a couple days to settle to where you can move it. Then you go in and do a conversion of that money. You convert it to Roth. It's all after-tax money. It's out of your checking account, savings account, what have you. You've already paid taxes on that, and it hasn't grown. So there's no growth to pay taxes on. Convert it to Roth. Now it's tax-free growth forever. But we'll go into the pro rata rule. If you have a bunch of pre-tax money in a traditional IRA, you get screwed. You can't really do a backdoor Roth. So the example, it's like cream in a coffee. Let's assume you have a traditional IRA. It's got $100,000 in it. You've got $93,000 from pre-tax money, whether it's a rollover from a 401k or it's just you had for years you contributed to a traditional IRA and took the tax deduction. Well, now you're like, okay, I'm going to just contribute this last year's $7,000 of after-tax money and then convert that $7,000. Well, as soon as you put that after-tax money into the pool with all the pre-tax money, it's just like cream in a coffee. It's all mixed together. So even if you only wanted to convert 7,000, the IRS says, you haven't paid taxes on 93% of that. So you're going to pay taxes on 93% of that $7,000. So you really need to have a large balance of pre-tax money in a traditional IRA to take advantage of this. Ways to get around this, if you have a 401k, most 401ks allow you to roll traditional IRA back into their 401k. So you could roll that pre-tax money into your company's 401k, and then you have a zero balance your traditional IRA. You're set up for doing the backdoor Roth and not paying any taxes. Questions on this? This is a very important aspect. Rich, did that answer your question? I know you specifically want to talk about this stuff. Okay, but this is important, and it's so valuable. If you don't do this, you just did it not. Yes, Riz.
So you can roll your company's 401k to a bet.
I'm really having a hard time hearing you. It's really
You
jumbled.
can roll a 401k.
Could you have a better speaker or anything, or could you chat the question and I'll answer it? Okay, Reyes, I'm gonna move on until, but when we can hear you, or if you want to put it in chat, I'll answer it then. Okay, here's another way to, if you're close to that contribution, that income limit to contribute directly to a Roth, this is one way you could do, another way you could kind of do it. You could contribute to your pre-tax 401k, right? That lowers your AGI. And then if you lower that below the income limit to contribute directly to a Roth, then you can contribute to a Roth. And if you wanted to in that 401k, or like now, even the TSP has in-plan conversions. So if you wanted more Roth dollars, you could then convert that pre-tax money to Roth. So that's just another way to do it, but you'd have to be in a small like income window to be able to do that. But it's just another chance. Okay, and I haven't seen any chat. Let's see, oh, there is. Reyes, did you ask? Let's see, okay. So Reyes, you asked, can you roll your company's 401k into a backdoor Roth IRA? Okay, you can roll a Roth 401k into a Roth IRA. You could roll a traditional 401k into a Roth IRA, but that would not be wise, because then you'd pay taxes on all that money would be a huge conversion. So what you'd want to do is, it wouldn't work for a backdoor Roth. That's just how to do Roth conversions down the road. What you do is, and we'll get into this, how you do Roth conversions, which is separate from just that annual backdoor Roth IRA conversion. That is just for the annual contribution to an IRA right now while you're working. Roth conversions are taking all that, whatever big lump sum of pre-tax money you have, and then being smart about converting a certain portion. So the right way to do it is roll it into a traditional IRA and then convert a bit at a year in a certain tax bracket. We'll have charts for that as well. Reyes, does that answer your question? Okay, good. Okay, excellent. Okay, let's see. Okay, as mentioned, here's, if you haven't, and you don't have an IRA or you haven't contributed, open it now. I like Fidelity right now because they have fractional shares on everything. So you can get, even if you only had $1,000, you could split it up, that $1,000 across all these different ETFs that have a globally diversified portfolio. Whereas typically ETFs trade like stock. So you say it's, $500 for this one share. If you only had $1,000 and you wanted to get 4 different funds, but they're each like $500, you could only get 2 of them if you had to pay the full price. Fidelity is better than Schwab or Vanguard in allowing fractional buying. So you can buy $250 of each of those shares if you wanted it split up, that equally like that. But that's why I like Fidelity right now. Their tech is best. But the others, they're all good. So, okay. So does anybody like a big refund check at tax day? I see Ginger smiling. You've seen this before. Yes or no? No? Good. Okay. Yeah, don't do it because you're basically just giving the government a tax-free loan. So if you are getting a large, and if you're military, you typically got a refund because we had so much tax-free money. Once you get out of the military, then you're like, holy crap, like, do I get to keep any of my money as your tax rate goes up so significantly? So you'll need to adjust your W-4 for your withholdings. But you if you can keep it within $1,000 or something, that's kind of ideal. It's anyway. Okay, buckets. Here's ideally, and I'm not saying you need a third, but these are the buckets you want to be filling up. The brokerage account, that's what I call the tow truck that kind of pulls you to 59.5 when you can use all your other money. Traditional IRA is, that's a pre-tax money, which you want some of that, and then Roth money. So you want a good portion in each. Let's see, if you're going to make a large down the road, say you're going to buy an RV or some huge thing, how would you pay for that out of these buckets? What do you guys think?
How old am I when I do it?
Yeah, you can pull from all these penalty free. So you're 60, let's say.
Okay.
You,
The next
you
question.
just retired and you're ready to hit the road. Go ahead.
Yeah, I was just going to say it depends on taxes. I would look at the tax implications for each of them.
Yeah, let's say the RV is 150K. What do you think?
Probably a Roth first.
Well, I don't know if Roth, it depends on what your income is. And that's the whole idea. Because any money you pull out of this traditional IRA, you got to count for that as income, depending on what your tax bracket is. So you wouldn't want to pull 150K out of that, because then you'd have to pay, a large that's all income that year. So you'd pay taxes on all that money you'd have to set aside. So you want kind of probably a split of each of these to where you keep your tax burden down. So you're not jumping into higher brackets just because you pulled this traditional money, but you also don't want to use all your Roth money either, because you want that tax-free growth to keep growing. So it's a balancing act. Does that make sense, Rich?
Yeah.
And then normal monthly expenses, that kind of would be more like where your traditional stuff would come in. Just as you're providing your own income in retirement through these resources, that's where, if it wasn't but as you get larger purchases, that's when you got to be much smarter about it. So, okay. This is sadly too often what people have. They haven't been smart about doing Roth, and they end up with all this pre-tax money. And then there's just a tax bomb waiting to hit when RMDs hit. So fortunately, now everybody has the ability to do Roth stuff, and I think people are getting better. But you don't want to do, I say here, either all Roth, because otherwise you're paying too much tax. There's always a standard deduction at a minimum that, that if you even took that money out, that exact amount of the standard deduction, which this year for single is 16,100, double that for married. If you pulled that much out of a traditional IRA and that was your only income, you'd pay zero taxes. So you don't want all Roth, but you also don't want all traditional. Okay, well, here are taxes we can't defer. FICA taxes, except for, like an HSA, Social Security. And if you have your own business, you got to double that up. You're paying because the employer pays half of Social Security and Medicare. But if you're self-employed, you've got to pay that employer portion as well. For California, so Medicare, there's no cap. Social Security, they keep increasing the cap. This year, it's taxed up to $184,500 of your income. For California, I'm using California because a lot of us live here. They used to have a cap on their state disability insurance, but instead, and it used to be 1.1%, but now they've bumped it up 0.1% each year and no cap. So what a surprise. California keeps taxing us more. But we'll get into potentially a good sign with California. Hopefully that comes to fruition for retired military. Okay, just real quick, figured those that aren't that familiar with the tax, the tax forms, gross income, that's, what you get, that's all your income sources. And then your AGI is your adjusted gross income. That's line 11 after you take those adjustments like pre-tax to a 401k, those kind of things come out, and then you get your adjusted gross income. Taxable income, that's after you remove your standard deduction or an itemized deduction. Since the Tax Cuts and Jobs Act, only 10% of people do an itemized deduction because the standard deduction is so large. And then it goes into sometimes pooling, like maybe taking a standard 1 year, taking an itemized every other year, something to where there's ways you can be wiser about that, like if you're charitably minded. But a lot of things depend on AGI and MAGI. So this determines, even though it's a higher number than your taxable income, this determines whether you can contribute directly to a Roth. It also, for the SALT deduction, that the state and local tax that went up, that also is impacted by your AGI as well. So, and modified, that's just adding tax exempt interest and some other tax deductions that probably don't affect any of you guys right now, but maybe a little bit if you had like municipal bonds or something. Any questions on this? Okay. And so, as we said, everybody got that right. We're in a progressive tax system. Higher taxes, you get higher tax rates. But to figure out your effective tax rate, this is where you take, your total tax divided by your taxable income, and you figure out what you're actually getting taxed on. Same thing, these are the lines for, at least for California, on their tax form. And these taxes, this is why I asked that question at the beginning of, do you think your tax is going to be higher in retirement or not? It partly depends on if you have an income or RMDs, but these show the lowest tax bracket and the highest tax bracket historically, and see how low we are really historically. And with the deficits, I could see tax rates. I expect, even though Trump made them permanent with the OBB, the One Big Beautiful Bill Act, permanent is with a pencil. Next administration comes in, their taxes are always subject to change. There's no such thing as permanent, but probably until through this administration, we'll have these lower taxes, and then we'll see what's going to happen. But I anticipate taxes having to go up, at least for the higher income earners down the range. And this shows capital gains and the highest marginal tax rate, the capital gains rate in orange there. Okay. Okay, so I'm going to go through some tables showing different incomes and how much you're going to pay in taxes if you did Roth or traditional or split. And these are basic assumptions. I'm not counting any rental income or dividends or anything like that. It's just basic income, only using standard deductions for simplicity. And I'm only accounting for 401k contributions and HSA as deductions. Any questions on this? Okay, here's the tax brackets that are permanently extended, and the 10 and 12%, this is for this year. The 10 and 12% though now will be adjusted for inflation starting this year. So, okay, and then the SALT taxes, standard deduction and SALT taxes. We already talked about this. Some people, that head of household, they've got a little higher one, but with the Tax Cuts and Jobs Act, they capped it at 10K, which in states like California and New York, it really impacted our ability. You used to be able to take that money off what you pay in federal taxes, but it's went back up to a limit of 40K, but it's modified. It depends on your AGI. So if you are making 500 to 600K, it starts dropping off until if it's 600K and above adjusted gross income, you are back down to the 10K SALT tax deduction. Okay, and I'm using Yes, these Tax Cuts and Jobs Acts did not sunset this year, January 1st, as they were scheduled to with the One Big Beautiful Bill Act. But I'm still going to use these rates as comparisons with just for that in case down the range our tax rates go up, which I anticipate. You can see the difference on how much you'd be paying. And you notice the thing is every tax rate is higher except for the 10%. So marginally, it's always higher. And that's where we're still in a low tax environment, relatively speaking. So that's considerations of, should I do a little more Roth potentially if I'm in the 22 or 24%, what have you, depending. Okay, so here's the California tax rates. And if you make over $1 million a year, that's a tough problem to have, but you get another additional 1% tax on you. Here's the capital gains rates. This goes into capital gains harvesting. Like if you stopped working and didn't have an income, you could sell up to nearly $50,000, almost $100,000 of gains and not pay any taxes on that if that was your only source of income. But that's something we could go into. But basically, a capital gain, I give the example there. Hey, you bought a stock for $10. You've got to hold it for at least a year and a day, and then you sell it and you get preferential capital gains rates. If you sell it in under a year, it's short term. It's just like it's income tax rates, so it's typically higher. But if you sold that stock after a year, it went up, $5 to 15, the capital gain is that difference from what you bought it at. So you'd be paying taxes on a 5% profit. But if you don't have income, because capital gain stacks on top of your income, you could sell and then rebuy that same stock at a higher cost basis and not pay any taxes. Is pretty cool. Okay, now we'll kind of flip through these quick. I highlighted different things just so you could see how much total federal tax is paid. This first example is assuming I'm using just married, so I don't have to go through it. If it's single, it's just half of this basically. But it's all the same. So, but different 401k, traditional versus Roth, and then using what the taxes would have been on those 2017 tax rates that who knows if we go up in the future. You'll see, but you can see your effective tax rates here. It says noticeably different, and you'll see it even worse as we go. But you're in the 22% tax bracket here, but only for a small amount of dollars, really. Okay. This is assuming that'd be a lot of money if people had a 75K, if they could contribute the max to the 401k. But that's in this case, if they did a pre-tax, you could only be paying $6,700 in taxes, 11% rate. And there's no difference you see on the California, because they don't account for HSA, you still get taxed on it. That's the difference in here, why your taxable incomes is higher. Okay, here's an example of, so if you're a household income of 250K, max contributions, it's almost 11. You're still in the 22% tax bracket, which is, depending on if you're retired military, what have you, that might be the lowest tax bracket you're going to see. So maybe it's worth doing Roth now in case tax rates go up. But if you don't, then, if you expect it to be much lower, then you could do more traditional and then potentially Roth conversions later in a lower tax bracket. Okay, here's this I gave an example of. Okay, the tax rates go from 22, 10, 12, 22, 24, 32. So a jump of 8%. And in this case, if you had a household income, is married of 470,000, I picked that so that it was a number that, you could actually, there's a you jumped like 20 something K into the, like 25K into the 32% tax bracket. So all that money from 403,000, I got here, right here. So if you're single or married or head of household, this 24% tax bracket is a key tripwire in my opinion. So if you're above, if you're above this, that's where you might want to do whatever traditional you can to drop yourself back into the 24% tax bracket so that not every dollar above these top ends are getting taxed at an additional 8%. Does that make sense? So that's why I put this, highlighted these here. So in this case, I probably want to go much more pre-tax and then evaluate doing Roth conversions down the road. Questions here? Okay. Okay, and these are, okay, with 500K, and I'm not accounting for, what I do want to point out though is this additional, on capital gains, there's an additional 3.8% net investment income tax that you'll pay that is not inflation adjusted. That's been since like 2010. And so it impacts more and more people, but you pay an additional almost 4% on capital gains for anything you sell, and rental income, that all kind of, it's all the same stuff. So, okay, anything else? Let's see. This is pretty interesting. Even like, look at these numbers. So the pre-tax tradition, even if you contribute almost 50,000 into the pre-tax versus all Roth, you're still almost paying the same amount of tax. That's why we're in a relatively low tax brackets, might consider doing a little more Roth right now. Okay, just to fit this in here, this is the same example of 500K family income, and what you'd be paying at for California, and then your overall tax rate. That's the overall meaning federal and state, not counting FICA. Okay, and then here, okay, this would be not a problem to have as having $1 million of income, but you can see now you've jumped up to the 37% tax bracket. I'd always be doing full on traditional at that. Doing whatever you can to minimize whatever taxes you're paying today, because you're going to pay a lot. So minimize whatever you can that's at that highest tax bracket. But it's still a noticeable difference on with those the Tax Cuts and Jobs Act. Okay, and same thing, here's just California, and this is your overall tax rate in California for federal and these. Okay, so catch-up contributions. The year you turn 50, if you made 150K or more in salary in 2025, then all of your catch-up contributions have to be Roth. They can no longer be pre-tax. Is that a big deal? What do you think? Any thoughts on that? Here's how, even before this, here's how I thought about it. At 49, if you were able to save more than the maximum salary deferral to a 401k, the only way you could save it where you could really invest it is into a taxable brokerage account, right? There you're paying after tax, you're going to pay, you've got to pay taxes on dividends, et cetera, and you've got to pay capital gains taxes when you sell those assets. Well, you're already paying those taxes, so why don't you have that tax-free growth where you're never paying taxes on dividends or anything anyway? So I would have already done Roth for the after-tax money anyway. You were already paying taxes if you could contribute more. Now we're forced to because the government wants some tax money now, but it's actually, to me, it actually works out just fine. Okay, questions on that? That makes sense? I guess just paradigm, how to look at it, in my opinion. Okay, now let's talk military tax advantage. I wish, I don't think we realize this when we're still active duty, just how much of a tax advantage we have. So I highlighted there all the tax, I'm assuming just base pay, BH, basic housing allowance, and basic, the food. So all the highlighted stuff though is tax-free money. This always kind of cracks me up though. Look at the BAS for enlisted is $477. It's $328 for officers. I mean, thought that was kind of funny. Like we joke, like there's in the military, there's this, enlisted, it's always, we work for a living. Like, okay, I thought, is that why they get more money for food? Because they got a larger appetite because they actually work for a living? I don't know, but it always seemed silly to me. What a noticeable difference it was. And when like underway as an officer, you end up coming out of your regular paycheck to pay the damn mess bill. It was so ridiculous. Like, what? Why don't you just get rid of our BAS? And instead, nope. Instead, we're paying out of pocket for mediocre food at best. Well, okay, on submarines it was actually better food than most others. But okay, enough on that. But see how much tax-free income there is. And I'm using California BAH rates, but it's significant. So here's 04 and 05. Yeah, I did it based on 14 years and 15 years. These are the current numbers. So you see just how much of our income is actually tax-free. Now, let's compare those same salaries if you're a civilian in California versus the military, and look at how much. This is why when you're active duty military, you should be going Roth all the way, unless you're going to just retire and never work again, which you can't do in Southern California typically, but at least for a while. But look at how much a little less taxable income there is. I mean, it's just crazy. Even maxing out a traditional IRA, you still got over $20,000 more of taxable income as a civilian, not counting what you're going to pay in California, than what it is. Look at your effective tax rates, 13%. Amazing. Okay, now here's an 03 over 4 years. So similar things. It's $36,000 less in taxable income. Okay, even 04, people are like, well, what if I get 04, 05? Still look at your numbers. Like, it's 107,000. You're still at a 17% tax rate as an 04, and then even as an 05, your taxable income, even though you're making over 200. You're making 188K. Yeah, that seems off. Your taxable income's still so much lower. That might be interesting. I had a number so it's actually should be 201K, but close enough. You see just how incredibly the tax advantage of the military is. So that's why if you can talk to people, make sure they're doing as much Roth as you can. Okay, now we'll go into RMDs, required minimum distribution. So you get an idea why you don't want to just do pre-tax for everything right now and save in today's dollars. Okay, I gave an example of if you contributed 23,000 for 30 years to a 401k, 8% rate of return, you'd have about 2.87 million. If you kept that growing, you went a little more conservative, once you retired and you just still had a 4% growth, which is very conservative, you'd still have a balance of 4.25 million. Now, for the RMD, your required minimum distribution that you have to start at 75, you have to take the balance on 1231 divided by this life expectancy. And here's numbers basically of that. So looking at the uniform life table, if you had that balance and you didn't do any Roth conversions, you would have almost 173K of income that you were required to pull out, or you get a 25% penalty. So in today's tax rates, that would be nearly $35,000. That's not counting any other income that you have. That's a minimum tax bill you're going to pay. Then I took also the numbers. If we use those pre-tax, Tax Cuts and Jobs Act, it'd be another almost another $13,000 you'd pay in taxes, because those rates, you'd be in the 28% tax bracket, and as mentioned, all those other rates are higher as well. So each 15% buys 12. 25 buys 22 and 24. So that's how you get screwed with the pre-tax RMD tax bill. Another thing, that's all considered income. So when you're paying for Medicare starting at 65, and yes, retired military, you're paying premiums for Medicare. So that's going to be a jump in our costs of healthcare downrange. But if you have this higher income, along with other things, you could only consider this, in my opinion, an additional tax. But you could pay an additional, these are premiums per person. So, a married couple could pay almost $12,000 more if they were in the largest IRMA bracket. And that's based on income 2 years prior, before premiums are paid. There's reasons you can say, hey, I retired, et cetera, where they'll negate some of that. But anyway, it's pretty significant if you have RMDs. Okay, so this is how, if aside from doing some Roth early, if you have a ton in traditional, IRAs, 401ks. So this is what we were talking a little bit about earlier, but with Reyes. So roll over that traditional money of the 401k to a traditional IRA. That way you don't pay any taxes. It's just moved from one bucket to another. And then you convert some portion based on where your taxes, every dollar you convert is income. So that's going to could potentially raise you to a higher tax bracket. So you want to do this wisely and convert a certain amount each year so that you don't get into too high of tax brackets, but you still keep building up that Roth bucket and lowering your eventual RMD bucket. So conversions, if you are less than 59 and a half, those conversions have to wait for 5 years in a Roth IRA before you can use those tax and penalty free. If for earnings, you still have to have at least 59 and a half and the Roth be 5 years old. But fortunately on Roth IRAs, the money comes out contributions first when you distribute to yourself, then conversions, then earnings on contributions, then earnings on conversions. So the earnings, which is the hardest wicket to pass to not pay taxes on, or penalties, is also the last dollars that come out of the Roth. So that's good. Questions here? Okay, so I just gave some examples. Here's examples of knowing what your income is and how much you want to convert. Like if you didn't have any income, like, okay, here's the 12% tax bracket. Maybe I'm comfortable going up to that. So I convert a certain amount of dollars to fill up this 12% tax bracket, while paying very low tax rates. And then rinse and repeat each year to build up that Roth pool. Okay. And the gap years, so the gap years are the years from when you retire, from when you really hang up, your W-2 or whatever, until you have to take RMDs, which is 70. I also think you want to take more advantage of it before you collect Social Security, which the latest you can to take Social Security is age 70, which is a good longevity play, especially for the higher earner. If you're married, it's ideal for a longevity play to wait till 70 so that the surviving spouse has the largest paycheck forever. Capital gains harvesting, we kind of talked about that, but that's selling. If you don't have an income, you can sell up to the 12% tax bracket and not pay any capital gains. So that's a way. But it's unlike wash sales, where if you do tax loss harvesting, you sell a loss and then buy it back, the IRS says, you can't do that. This is a gain, but you're just not paying any taxes because you're under you're in the 0% capital gains rate. So you could sell, let's say you got $50,000 in gains on, say, Apple stock. You sell it all, and then you buy it right back that same day, or at this higher cost basis. Now, when you want to sell it down the road, that $50,000 of gain is already accounted for. You haven't paid a cent. And then when you sell it down the road later, it's going to be a much smaller capital gain that you'll see. Any questions there? Okay. Okay, once again, we already showed this California tax rates, but I go into that about, do we establish residency outside of California? That's sadly what Right now, though, there's a bill, Senate Bill 1407 that's going through, and I just got this latest status as of April 8th. This is getting rid of all taxes on military pension for that's what the push is. Currently, there's actually, last year they had passed something that allows up to 20K of deduction, but it's based on an AGI of 125K or less, or 250K or less for married. So for most people working here with a pension, and sadly, especially in Southern California, you're like capping it, going over that. But this is hopefully going to keep the exodus of all the retired military from leaving. And California, if they're smart, they'll realize they're losing money by everybody leaving instead of staying here and living in the economy, and then their kids stay here and live in the economy. It's, but California is just not the smartest sometimes. And I give some examples of other states. Virginia has up to 40,000 of your pension that's subtracted tax-free. Arizona, 100%. There, a lot of them are. Georgia, they just changed it. It's starting this coming year, but up to 65K of the military pension is not taxed starting January 1st. It used to have to be 62 years or older. Okay, here's you guys. Here's all the states that don't tax a pension. And then I'll just go over some basic age-related rules about the, 59 and a half. If you pull money out, typically you're going to pay income tax and a penalty on pre-tax money. If rule of 55, like I said, if you retire from a company, the year you turn 55 or later, you can use that 401k money tax and penalty free. And then everybody needs to open up a Roth if they haven't already, because if day one you open a Roth and put $1 in, it starts that 5-year clock. That's essential for tax-free gains. Okay, let's see. We already kind of talked about this as far as the trifecta, balancing this out. And then for your homework, I say, one, review your especially those of you that already done your taxes. You see where you're at. Take a look. Are you doing your contributions right, or do you want to, you do a little more Roth, or are you too high and you want to do a little more traditional? If you haven't, open and fund as much as your traditional, or I think only Roth. I love Roth IRAs before the 15th next week, and then I like to update my net worth quarterly. I've got a net worth tracker on my website that you can put in, and it splits out the money into the different buckets too, so you can see where you're at in that how that looks. Okay. Any questions? That's a link to my website, and we're not connected already in LinkedIn. And then if you don't mind doing a quick survey, it takes like a minute or two, if that. Appreciate it. Questions? No questions. Okay. Well, I'll stay on here for a minute if you guys have any actual questions. It's kind of a shy crowd today, it seems like. But and next month we'll try to do looking to do one on home buying, and then probably I was going to do net worth and 401k balance by year, but Fidelity and Vanguard, they haven't updated their numbers yet, so I'm waiting until they actually do. They only have it based on like currently by generations, which I don't care about generations. I want to see the individual age numbers for the different things, so we can really get an idea of seeing where you're at, not a generation. Like you could be the early part of a generation or the end. That doesn't make any sense. Okay. Okay, well, if that's it, have a great weekend, and hope to see you guys
Thank you, Alan.
next time.
Thank
Thank you.
you. Bye.
Yep, be one.